Okay, I'm going to go ahead and get started. Just a sort of logistical note. After we're finished here, we're going to go outside, and you saw the wait staff was actually setting up for plated lunches. But we'll eat, and then the afternoon keynote will be right at the tail of lunch out in the Commons. And then after that, we'll reconvene back in here. So you can sort of relax and enjoy the much sort of more open space there, if you will. But what I want to talk to you now is about really a key element of the study that is really at the core of why we're here today. One of the things that I was involved in specifically was trying to understand all the drivers of oil price. It's an impossible task, admittedly, but certainly it leads you into the path of not just, I think the phrase earlier was used, counting barrels, right? It's not just about that. In particular, when you look at sort of more recent history, you begin to notice certain sort of fundamental differences emerge, that some of which Daniel actually highlighted very, very eloquently in his talk. And so you'll see some replay of some of that information in what I'm going to say, but it's going to be tied more generally into a broader characterization of the physical market as well. So this graphic, and you don't really need to be able to read all the text in the figures, but Amy and I were actually sitting together one day in my office, and we were trying to think about this whole notion of cycles, right? And we were contemplating, well, how do we actually depict that in the recent sort of 40-year history of oil? And we came up with this idea, which is to look at the latest sort of recent run-up in oil price and compare it to the last. And what you see here in the black line is the price of oil on a monthly basis, running from 1973 through 1973 through 1997, sorry. And then again from 1998 through the current time. That's the red. And so basically you're just seeing that latter part of the time history sort of shifted over so that it coincides with the sort of earlier part of the previous time period. And what you notice is up through about 2008 relative to 1982, there's a lot of similarity in what we're seeing in terms of real price movements. So these are inflation-adjusted prices. And you can point to specific events that occur sort of along the way. And sort of it leads you to ask the question, is the past a prelude to the future, right? Is it deja vu all over again, to use the Yogi Berra quote, right? But is there the possibility that we could see oil prices collapse? That's ultimately, the question that we started to ask ourselves. I'm not going to spend a lot of time dwelling on this. What I'm going to do is talk a little bit about some of the fundamental features behind this picture, because Amy's going to bring it up again in her talk later this afternoon. But one thing I will point out, and I think it's a very relevant point to note, particularly given the last talk, is that if you look at the last part, this is supposed to work, but it doesn't. Notice this time period relative to this time period. So everything sort of looks, very similar until you get into that sort of range of oil prices. And you just have to ask yourself, well, what's the big difference? There were three distinct events, if you track the red line, that occurred related to U.S. monetary policy in particular. QE1, QE2, and QE3. Right? That contrasts dramatically with what was happening in the early 80s, which was the Volcker disinflation. Okay, so U.S. monetary policy was dramatically different in those two time frames. And so you can start to ask yourself, is there some fundamental relationship then between U.S. monetary policy and oil price that explains this difference? And I think it's a reasonable question to ask. So what I want to do before I sort of even address that is talk more about some of the more fundamental issues. In particular, when you look at, ultimately, if you get down to, you could talk about oil price, but you're talking to a physical guy, right? It's about, what does it cost to drill a well, right? At the end of the day, that's really important in determining the marginal cost of supply. Ultimately, that matriculates into price. And one of the things you see historically is that cost. So what you actually see here in the black line is the cost to drill a well. It's an index. It's a PPI for drilling and completion. It's available from the Bureau of Economic Analysis. This is all done on an annual basis, but this data is available monthly. There's a little bit more noise in it, so I just, to smooth things, give you annual representations of the data. But what you notice here is the black line and the red line, which is the price of crude oil. They tend to be moving in the same direction, right? They move with each other. And so this is a pretty fundamental feature of what determines oil price. And quite frankly, it gets at the heart of the nature of cycles, right? When you see costs rising, and these are in nominal terms, they're not in real terms. I'm going to show you an inflation-adjusted measure in just a minute. But when you look at costs of drilling wells rising, you typically tend to see prices rising as well. And when costs fall, guess what happens? Prices fall too. And so it leads you into the question of, well, why do costs fall, right? What's sort of the breaking point? And I think that's a really important question. A lot of it has to do with demand destruction, but it also has to do with rents that begin to emerge in the marketplace, in the upstream in particular, that starts to see new supply come forward. And it just so happens that those two things work in opposite directions. So when you see higher prices, you start to see rents emerge. That's when supply begins to come forward. But at the same time, what are consumers doing? They're taking actions to increase efficiency and reduce intensity of oil use. And so those two things clash ultimately, and you end up seeing some softening in price. And we've seen that in the past. It's reasonable again to ask, will we see it again in the future? So if we look at price normalized on cost, so this is where I take that price series and then I adjust it based on the relative, so the cost of drilling and completing a well. And what you actually see here is it's another way to characterize the real cost of oil, or the real price of oil, I should say. What you actually see here is, I think, quite interesting. During periods where prices are generally trending upward, you actually can relate that back to what's happening in the upstream sector, in particular investment opportunities. You begin to see upstream, so supplies begin to respond positively. But then at some point, this whole thing begins to trend the other way, right? So we see this in the early 80s and in the mid 80s through basically the mid 2000s. You see this actually trending the other direction, and that's when you begin to see a lot of softening in terms of what's happening in the non-OPEC oil supply sort of domain. In effect, what this is telling you is that the returns to investment are beginning to be lower than what they were in the previous period. Then, of course, we sort of fast forward into the latter half of the first decade of this century, and everything turned around again, right? So it's reasonable to, look at this picture, and you might take the standpoint of, well, prices and costs are going to continue to rise, the returns are going to be there, so we're going to continue to see a lot of non-OPEC supply growth. Okay? But then you can turn around and say, well, at what point do demand side factors begin to bite? And that's a really relevant question, because that's when you could see this whole thing reverse trend again. And of course, when you get into price expectations, this is really important too in terms of driving ultimately the supply response, right? So what you see here in the black line is the nominal price of oil. It's just the spot price of oil. And then each of the lines that sort of trend off at different points in time are long-term forecasts that were put forth by an agency of the United States government. So go back in the early 70s, it wasn't the DOE, right? But or the EIA, I should say, but it was the Federal Energy Administration. But the point is, you can see these forecasts, and there's actually a nice sort of interesting kind of trend, which I think really indicates a little bit of adaptivity in expectations. So when prices are starting to trend up, there's a tendency for the expected price to be going the other way until they're trending up for a sustained period of time. Then all of a sudden, expectations shift, and you see this radical uptick. Right, so notice here, relatively flat, prices start to trend up, stays flat, but they're up for a while. What happens? All the projections are for $100 oil by the 90s, right? Then things soften, and again, I say adaptive expectations because right through here, right, you're seeing that there's this sort of lull, but all the projections are for higher prices. This is just a temporary thing. And then everything, the bottom falls out, and then the projections are flat again. Right, so everybody's sort of wised up, so to speak, until we start all over again. Okay? Now, this is all relevant because when you're making investments in the upstream, so when you talk about the supply response, understanding what this projected market looks like is going to drive what happens. Right? So we can actually use this information to begin to understand the upstream response, so what's going to happen to supply. One of the things we can do to sort of highlight this point a little bit more closely is we can actually look at what's the expected price 10 years from today versus the current price. And you can look at that spread. And so that's what's graphed here. And I have the little dotted lines here to coincide with the dotted lines here. Okay? What you notice is the spread gets really, really wide in the late 70s and early 80s. So everybody believes that the price is going to keep going up. That's really what this is telling you. This is about the same time you see a lot of money, particularly in the United States, pouring into the oil market, right? A lot of investments were made. I mean, for those of you who are old enough, I'm not admittedly, but you might remember back in the mid-'80s, the bottom fell out of the crude oil market, and there were a lot of people that were in a lot of pain, right? Why is it? Because they believed what this picture was telling them, right? That the price was going to go up. It was a safe bet. It was an all your eggs in one basket kind of mind think, right? So you move sort of beyond that, right? And then those expectations soften dramatically, and you actually begin to see what you might actually interpret this as a return graph begin to be, in some cases, even negative. Well, what that means is that supply is not going to be aggressive in terms of growth as it was in the previous period, and therefore you're not going to see these supplies come online. And again, this is working against what's happening on the demand side, because when these returns are soft, prices are soft, you're actually entering into a paradigm where, because prices are softening, consumers aren't as concerned about efficiency, right? They're not as concerned about reducing oil intensity, and so demand begins to grow, right? And then the whole thing starts over again. Now, it's always useful to use anecdotes, but if you think back to the early 2000s, right? Think about the year 2000, if you could remember then. If you watch TV, you see automotive commercials. How many vehicles can you name that actually used efficiency as an advertising motive? None. If you watch TV today and you see what's happening with advertising around motor vehicles, how many vehicles can you name that use efficiency as an advertising motive? Every single one. The Ford F-150 talks about fuel efficiency. So, it's about appealing to the consumer mindset, and the consumer mindset's one today of prices are high, we need to actually think about efficiency and reducing oil intensity. So again, this is working against what's happening in terms of projected returns in the oil space. You can see this to an extent when you look at supply side response, and this is just US oil production monthly going back to 1951. So you might remember, the famous predictions by King Hubbert, and I think Mahmoud's going to talk about this a little bit in his talk today. But you can see the production peak, and there's a question around that in the early 1970s. And then everything started to fall. I'll just say this, I'm not a peak oil person. As a matter of fact, the reason we stopped producing oil isn't because there wasn't any oil, it's because there was a cheaper alternative, imported oil. But when you look at this graph, you can see definitive reactions to changes in price, right? So when you look at the mid-1970s to the early 1980s, that was a period of rising price. Look what happened to the trajectory of oil production. It actually turned around a little bit, right? So this is a supply response, right? Returns in the upstream sector looked really good, as I was just talking about. What happened? Money flowed there, brought new oil. It was more expensive oil, so when price fell, what happened? The barrel at the margin got kicked out, okay? Well, what we're seeing today is remarkable. This relates back to something that Edgard mentioned in his opening talk, light tight oil or shale oil, right? It's really been the harbinger of change with regard to US oil production. We've seen dramatic growth, in fact, year-on-year growth since 2008, so that's 5 years running now, and that hasn't happened since, well, you can see the picture, right? So it's a dramatic shift. But what's true today? What's been going on? Oil prices are high, right? So it's encouraged some entrepreneurial activity, going into new frontiers, diving in a new place, figuring out how to bring this stuff to bear, make it commercial, right? And so you're seeing the fruitions of the labor, so to speak, right? But you have to ask yourself, with this new oil coming online, if there's any sort of negative demand side pressure, again, are we setting ourselves up for another repeat? This is just a brief discussion about the ongoing developments in tight oil, and I mentioned this slide, I put this slide in here because I wanted to not only highlight all the different prospective basins that exist in North America, but as you may or may not have seen, there was actually, the ARI did a study back in 2011 for the Energy Information Administration, looking at shale gas opportunities around the world. They have updated that study to include shale oil opportunities. It's available online, but what they've noted is that in terms of the barrels that might be available, and these are assessed resources, right? So there's no cost associated with this or anything like that at this point. But in terms of those barrels, you're talking about upwards, if you include the U.S., 320 to 330 billion barrels in shale resources. And this is a resource, particularly when you get outside the U.S., where you're talking about 260 billion barrel potential, we haven't even really drilled any wells into shale, right? I guess recently there was one drilled up in the Amal Peninsula. There was some hydraulic fracturing activity done in Russia around, it was an oil target. But the point is when you think back to natural gas, all right? The initial assessments about shale gas, if you go back to 2005, 2006, EIA was using in 2005 in their annual energy outlook, and this was on the heels of the Barnett and Fayetteville shales beginning, 140 trillion cubic feet total. We're an order of magnitude larger than that by most assessments today. So the point is we're going to learn as we start to do more and more of this stuff. So you have to ask yourself, if we see a repeat of that on the supply side in the oil market, what does that mean? Right? Because you're basically adding barrels to the supply portfolio. You can't ignore all the other sort of fundamental things that are out there too, right, in terms of driving price. And so what's graphed here in the red is the commercial, it's OECD commercial inventories. Unfortunately, there's no real good inventory data for China or other countries that are actually stockpiling oil. So this is kind of what you have to rely on as a barometer of what's happening globally. It's very much an imperfect barometer, particularly given what the Chinese have been doing in the last decade or so. But it is the only hard data we have. And what you can see here is that in general, inventories have been rising. Okay. Now, why would that happen? Well, it's basically a reflection of market growth. Okay. Typically, you hold inventories to mitigate disruptions, right? And if the size of the market's going up, then those disruptions in terms of scale could also be larger. So there's actually an incentive to hold inventories. I'm going to come back to this point in just a few minutes. But the other thing in the bar graph, the dark blue, is OPEC spare capacity. Now, you look at this, and generally people say when spare capacity is low, price should go up. Flip side of that, when spare capacity is high, price should go down, right? But it doesn't necessarily always hold because you have to look at the motivation of OPEC. So when you look in particular at the late 70s, early 80s, you see spare capacity was as high as it's ever been. But that was a conscious decision by the Saudis to withhold supply, right? So that, of course, all reverse trend when you sort of get into the 80s and mid-80s in particular, and the oil price fell largely because the Saudis started to produce a lot more. Now, when you fast forward into the 2000s, you start to see a much stronger relationship emerge between spare capacity and the price of oil. In particular, if you look at the graph, you can see in 2008, spare capacity was really low, right? Just so happens that's when oil price reached its all-time high, right, was 2008. 2005, it was also very low. As a matter of fact, if you look at the early 2000s, and again, this goes back to something Daniel raised, right, about there actually being the potential for other factors to have influenced that structural shift. What do you notice? You notice that spare capacity bottoms out around 2003, 2004, 2005. Okay. That signals an incentive to invest financially in a commodity whose demand continues to grow, but spare capacity is falling. It signals scarcity, right? So some of this could actually be a harbinger of what eventually happened in financial markets, but I digress. Now, another important thing to look at when you're thinking about short-term scarcity is something called the demand to inventory ratio. So what is market demand relative to total inventory, right? If demand's high relative to inventory, and here we're just using OECD commercial inventories, recognizing again it's imperfect, right? But if demand's high relative to inventory, that signals that scarcity is rising, okay? For those of you who follow natural gas markets, this happens every year, right? As a matter of fact, if you have a cold winter, demand inventory blows out and you actually see price go crazy, okay? It rises a lot. In oil markets, it's a much sort of slower kind of trend. But largely because oil demand is not as weather-driven as gas. But what you should notice here is that in the 70s, in particular the late 70s, you see that demand-inventory ratio sort of reach pretty high levels. What do we also know happened then? Well, price reached pretty high levels, right? Then it begins to fall. And you can ask yourself, well, why is demand-inventory ratio falling? It's true inventories were rising, right? But there was actually also something happening on the demand side, which is going to be addressed in later talks. But it really has to do with efficiency gains. Okay? There were some policies put in place that really did begin to lower demand for oil. Okay? Couple that with the negative growth policies is how they've often been characterized. You think about the Volcker disinflation, right? There was actually some concern that what he was doing in terms of basically hitting the reset button on the economy, that it was actually going to be very deleterious and have negative effects on the economy. And it did for a short period, but in hindsight, hindsight's 2020, a lot of people credit that particular activity with the 2 decades of growth we saw beyond that. So that's fodder for another discussion. But the thing that I want to point out is notice where we are today in terms of demand inventory ratios. They're basically where they were back in the late 70s, and they've been there since the early 2000s. What do we know has happened to oil price since the early 2000s? It's risen steadily, right? So this is a good sort of gauge of trying to understand what's happening. Now, having said that, you see the quote, if you're reading the text, source of speculation with a question mark, right? Because anytime you start to see signals of scarcity emerging, right, that might actually attract investment into that particular sector that, in effect, could exacerbate the price signal that's carried in this particular data. So, again, I'm going to come back to this in a minute, but the point is if you see this scarcity emerging, it makes perfect sense that you want to hold more inventory. One of the ways you can actually affect that change is through futures markets. Okay? Because what do I want to do? Typically, if I think price is going to continue rising, I want to hold so I can sell forward, all right? Which in fact means you're taking financially long positions. So when you think about that, you begin to understand how, if scarcity is emerging and there doesn't seem to be any end in sight, and when you look at this, you see 2001, we sort of reached into where we were in the late 1970s, and we've stayed there for a decade, right? Might that mean that some speculative pressure exerted itself in the marketplace? Demand response, I mentioned this a minute ago. One of the things you have to look at, though, is the oil expenditure share. This is of global GDP. So this isn't for the United States, this is the total world. So when you look at the dark blue line, that's world oil demand, right? You can see there it was rising through the 70s, big dip, largely due to demand-side policies taking effect, as well as some economic frustration, to say the least. The world economy was going through a bit of a downturn then. And then things take off again, right? Demand's growing until you get to, well, the crisis in 2008, 2009. You actually see demand soften again, but then it picks back up. Interesting thing to look at is what is oil's share of GDP? How much are we spending, right? And what you notice is when demand dips the most, it's when the oil's expenditure share of total GDP, so most of our income, a higher proportion of our income is flowing to purchasing oil, when that rises the most, okay? You can see it rises again in the late 2000s, right? 2006, 2007, 2008, but it doesn't reach the heights we saw previously, right? A lot of that has to do with we're more diversified in terms of our economic activity. Oil is a smaller share of total energy use, total primary energy use than it was back then. GDP's grown, and that, I think, is in no small part because if you look at what happened to the expenditure share of oil and GDP from the late 80s through the end of the 2000s to the beginning of the 2000s, it's very, very low by historical standards, right? So that's when you start to see world oil demand really begin to grow. So other factors, and here I'm going to touch on. So there's a lot of stuff to take in, right? I'm going to touch on a couple of other points. One that really began to gain a fever pitch, if you will, was peak oil, right? So we go back to that declining OPEC spare capacity diagram. Amy mentioned the Matt Simmons phenomenon. I think that's very well stated because right around that time is around the time he was actually sort of on the circuit, so to speak, talking about this stuff so much. And it was getting a lot of traction. The idea really matriculated into we're running out, right? Hubert was right. It's over. And again, Mahmoud and Amy are both going to talk about these points later. But it had a really strong bearing on expectations because about the same time is when you begin to see the forecasts really tip up in dramatic ways, right? Exchange rates, Daniel just talked about this a little bit. Amy and I actually wrote a paper back in the end of 2007 talking about this issue, addressing this issue slightly. It's an interesting one. This is just looking at simple correlations. If you go from January 86 to December of 2000, there's virtually no relationship, as Daniel pointed out correctly. That's apparent. But if you look beyond that period, the correlation jumps to an incredible high. And so this is not looking at returns. These are actually just levels, so movements in the prices. And there's nothing causal in this. It's just a statement about correlation, right? But you see it jump to negative 0.884 post-2000. You have to ask yourself, what happened? Mind you, perfect correlation is -1, right, in terms of the inverse correlation. So something happened that's just dramatically different, because that's a long enough history to, you can't just sweep it aside and say, you know, this is just an aberration in a short time series. It's not a short time series anymore, right? As a matter of fact, the time periods are almost identical in terms of the length of time. Something is different. What is it? I think Daniel touched on those very eloquently in his talk, and so I'm not going to dive into it, but it does have to do with the financialization of commodity markets, you know, them becoming an asset class unto themselves. We did a study here looking at national oil companies. It's always fun when you can look back at things you've done in the past and they build into something like this. But one of the things we identified is that firm efficiency in NOCs is generally lower. That has to do with competing objectives that are non-commercial typically, but why that matters here, in particular around why people were thinking that oil prices were going to continue to rise, is because a greater and greater proportion of the world's remaining oil reserves were in the hands of national oil companies. This is conventional, right? This doesn't include tight oil. And so what that means, if you're less efficient, less revenue efficient in particular, is that prices generally will have to be higher to support production growth. Okay? So when you think about that, and you think about a world that people were envisioning just about 5 or 6 years ago, where NOCs were going to become ever more important in meeting world oil demand, it was natural to say, well, that means price. That's a positive signal for price. Price is going to go up. Skip that one. Oil demand, that's another one that, you know, is sort of always in the discussion. A lot of people talk about China and India over the last decade, and really China in particular, what's going on there driving world oil demand. What you see here is some work that we've done here at the Baker Institute, and you can see a couple of countries highlighted. This is, quite frankly, if you go from 2010 to 2040, so beyond that black line, everything in front of it to the left of it is history, right? But beyond it is a forecast, so it's a projection for what's going to happen to the demand for oil by country globally. Notice the big red and the big sort of yellow-orange at the bottom, right? That's China and India, so that's the emergence of the large Asian economies. Notice what happens to Chinese oil demand relative to U.S. oil demand by the time you get to the end of the time period, right? It's basically on par. So when you look at that, and this is the kind of view you have, and you juxtapose it against the 2 previous points I made about national oil companies and concerns about peak oil, where do you think oil price has to go? Right, so expectations were trending up. And then there was, of course, the discussion about speculation, right? It's, you know, at one point it reached a fever pitch. Oil prices are only rising because of speculative pressures. As you'll see in a minute, the work that we've done here does not indicate that. Actually indicates it's a basket of things that have actually driven price. But what you actually see here, if you're looking at the, let's focus on the green line, right? That's total open interest in the market as reported by the CFTC back when this data was collected. It's since changed, right? So it's not an apples to apples comparison. But the black line is the price of oil. And the red line is the share of non-commercial traders. So what you see is non-commercial share of open interest is growing at the same time the scale of financial trading in oil is growing. What that tells you is that they're driving the boat, right? You also see price go up. So this is natural for people to say correlation is causation, and they point the finger at what's happening in the financial sector. So there was a lot of concern about this. It's triggered a lot of, you know, new regulation and discussion of you know, even further regulation over oil markets. And one of the things that we actually intimated, Amy and I, in a paper that we wrote back then, in which this figure is actually pulled from, you need transparency. There's no way you can make informed policy if you can't see the data. It's really just that simple. And even today, when you're looking at, you know, these markets, it's not transparent. The stuff that you can see only represents a small fraction of total trading, and this is anecdotal, right? But once you sort of get your head around that and you start to realize, well, how can I make any statements about correlation and causation if I'm only looking at a subsample of the data? I can't. Okay, this is a really important point. So if we're ever going to get to the root of this, The doors have to be flung open. It's that simple. So what we can now do is sort of bring it all together, right? How do you roll all this information into a sort of a single framework? I'm going to show you a couple of supply-demand diagrams. I always joke I wouldn't be a good economist if I didn't do that. So I'm going to do that because it really highlights a framework, and then I'll skim through some equations really quickly because I don't want you to get lost in that. And I know my eyes glaze over, and I'm used to looking at equations when somebody shows them on a screen. But I'm going to fast forward to the punchline. Okay. So for those of you who've been involved in the workshops, you've already sort of seen this, so just bear with me. One of the ways you can actually look at price variability is to examine things from the standpoint of inventories and flows. So this is where you get into something called the stock flow model. So on the left-hand side, you have a market for inventories. Inventories at any given point in time are fixed, and so you have a supply curve effectively that's vertical. On the demand side, you see downward sloping demand. Why is that? Well, because I'm going to want to buy more inventories when price is low. Why? Well, because generally when price is low, I'm pretty sure price is going to rise at some point, right? And so that's the idea behind inventory markets. You want to buy low and sell high, unless you're the U.S. government, right? Then you tend to turn things upside down. But I'm referring to the SPR policy back in 2008, by the way. But the reason you do this, that you want to hold those inventories, is precisely you want to be able to mitigate demand response. So if you look at the flow market, so that's the market on the right, you can actually see production, that's the curve Q. It's going to go vertical at some point because you've only drilled so many wells at a given point in time. So you are capacity constrained with regard to what you can do to provide supply to the market in the short run. Okay? You can augment production capacity, though, by withdrawing from inventories. And so that actually means that the elasticity of supply, so that's the curve S, is greater than the elasticity of deliverability, right? If we're just constrained to what we can produce, sort of just-in-time production, if you will. So you need inventories to augment productive capacity. And in fact, what that does, if you see demand swing throughout the year, for whatever reason, rather than rising all the way to the red in a high demand period and falling all the way to this red in the low demand period, you mitigate the price variability because of the ability to enhance deliverability with inventories. Okay? So this is a classic way to discuss natural gas markets, by the way. Right? This is exactly the volatility dampening benefits of a robust storage market. Now, how does this apply to oil? Well, you can think about the same framework in a longer term context. And in particular, you can think about the same framework in a longer term context, but roll in the idea of expectations. Okay. So where do expectations fit into this? Certainly in the long run, they fit into shifting the deliverability curve out, so increasing Q, right? Because that's where upstream producers come into the fray. But in the short run, expectations come in through the inventory market. So how strong is the demand to hold inventories for delivery at a future date? If expectations are that the market's going to become increasingly tight, then you should actually see more and more players wanting to hold inventories. So in other words, in terms of financial parlance, it's going long, right? What that means is that demand curve shifting up, and it's actually driving up the value of inventory, existing inventory. Now, the standard sort of Samuelsonian response, and you probably saw literature and discussions about there's no way speculation can be driving the price of oil, because what happens is you'll get a disconnect. Demand will respond, so demand's going to fall if price is driven up. Productive capacity is what it is, so you get excess supply in the flow market, but what that does is it flows into inventories to meet that demand for inventory, and that keeps price from rising. That's the standard response, right? Trouble is what if demand's highly inelastic? So what if in the short run demand is not responsive to movements in price? Most of the literature indicates this is actually the case, right? And I think anecdotally people would tend to agree with that, right? Well, that means you don't get a big supply response, right? You don't get a growth in inventories that's that appreciable. And when that begins to happen, then you can, in the demand for inventory phase, you get these expectations that become reinforcing. Remember, you thought the market was going to become increasingly tight, so you begin to value inventories more highly. You see no inventory growth as price rises. Therefore, you must be right. The market's becoming increasingly tight, and it reinforces itself. And what you can get is a runaway train, okay? Until something happens. Something has to happen to break the cycle. And that's where we get into the fruit of the discussion that again, Mahmoud and Amy are going to dive into in a lot more detail later. And I'll just touch on it a bit here, but it really is about demand response and supply response. So what's happening physically when this stuff happens. So again, I told you I'd show a bunch of equations. There's a lot of variables that flow into this. Ultimately, what it boils down to is understanding, and I'm going to stop here, the effect of changes in inventories, changes in other exogenous factors like world GDP growth, for example, changes in producer expectations for price, or what's going on, right? What do we think the price is going to be 10, 20 years from now? Changes in cost. What production looked like last period, because you're talking about a market, right, that's heavily dependent on where we were yesterday, right, in terms of crude oil supply. Epsilon is the exchange rate, so what's happening to the value of the dollar. And then the futures market rolls in, again, because you have to integrate this notion that you can get this speculative push from the demand for inventories. And so that means you have a simultaneous system of equations where you actually have to model what happens in the futures market as well. Okay. Now you can see little pluses and minuses below all these variables. We actually estimated this system of simultaneous equations, and this is actually the sign of the coefficients that you see come out. One thing I want to point out is that you have down here to reflect shifts in expectations, because there is no data. I mean, how do you model expectations, by financial market players? There's no data that tells you that, right? So it's an unobservable factor in this framework. And so what you can do is you can decompose the error term, if you will, right, in this second equation and look for those systematic sort of impulses. That's one of the most interesting parts about this, because the other things that play out exactly as you might expect, right, when you estimate this system. So in other words, if inventories are going up, that puts downward pressure on price. Okay. Spare capacity is going up, that puts downward pressure on price. If world GDP growth is positive, that puts upward pressure on price. If producer expectations are that prices are going to continue to rise, that actually puts downward pressure on price because it tends to bring more supply to the market. If costs are rising, that puts upward pressure on price, right? It's the marginal cost, that marginal barrel gets more expensive. What's going to happen to price? If production last period was really high, that tends to put downward pressure on price. So the state of the market also matters, right? If the value of the dollar is going up, and there's a positive relationship here because of the way this is represented. It's the inverse of this. But if the value of the dollar is going up, that actually tends to put downward pressure on price. Okay? So this falls out in the data. It falls out in the wash. And this, mind you, again, is a market model that's sort of taking all these factors into play. Okay. What's going on in futures markets? And here we're looking at the 12-month strip. Right? So it's an average as you sort of roll through time of the 12-month strip. Has a positive effect on the spot price. Down here you can actually see the demand-inventory ratio has a positive effect on that, which in turn, through the system, affects price in a positive way. Right? So the idea here is that if the market looks increasingly scarce, you're going to see the futures market, in effect, pulling the spot market. That's what this is telling you. Okay. Now, that variable eta, that's what I'm going to focus on here. So this is actually the last slide. But you can actually look at the real price of oil over the time period that was analyzed here. And this is using quarterly data, because that's what we had to rely on, because ultimately you want to use world GDP, and unfortunately there are no estimates of that on a monthly basis. I'm actually considering looking at industrial production on a global scale, because you can get that monthly, but neither here nor there right now. But the point is, when you look at this through time, what you can see in that term eta is that there were a couple of points in time where it became very strong, right? It really jumps out. Two of which were very recent, 2008 and then the 2010 to 2011 time frame. What this signals is that there's something in the market that is signaling scarcity, and it's creating demand pull from the stock market, from the inventory market, right? So this is not necessarily the classic count your barrels explanation. There's something else that's influencing price. Now, I want to point something out, because I did say this, right? Something was influencing scarcity first. So there had to be something physically right so to speak, about the market for the speculative pressures to emerge. Right? Because if you have a market that's fully responsive because demand's softening, right, then inventories will grow and you'll get immediate reaction. However, if inventories are low, demand is actually recovering, if you will, or strong, then you're not going to see that, right? You're not going to see the inventory growth, and that can lead you back to that vicious cycle that I referred to. Okay. So, you can sort of look through this. I pointed out the Volcker disinflation, and I just repoint that out because what you actually see is the U.S. dollar gaining in strength through that period from 82 to 86. And that tended to, at least in the data analysis, reveal as a sort of negative pressure on oil price. Now, there were other things going on there too, so you don't want to oversell that, right? One of the things that I mentioned already and is going to be talked about later were the demand side responses that began to materialize in the early 80s, right? Those are very important as well. And finally, the supply side. What was going on in the early 80s on the supply side? Production was growing. So you had demand falling, production growing, the dollar gaining in strength. All of those spelled negatively for the price of the barrel of oil. Okay. Finish with this slide. It's what I showed at the very beginning. Is the past a prelude to the future? Hopefully this graphic will be fodder for a lot of discussion, in particular in the panel this afternoon. Because Amy's got some really interesting things to say about this, in particular around the geopolitical points of intersection. So you see a lot of things that are highlighted here that you can't really read. Some of those are a lot of those are geopolitical in nature. So there's a lot of things at play, and quite frankly, the geopolitical events are ones that I can't really capture in what I did. You could think about the use of dummy variables. At some point, you can fully saturate the system. You don't know what it's telling you anymore. But the point is they matter. They definitely matter. And they have an influence that might be showing up in terms of speculative pressures, to be honest with you, which is perfectly consistent with the story that there's a premium, a speculative premium exerted by something like the Arab Spring, right, in the oil market. Okay. I'll stop there and entertain some questions if you have any.
Just a quick one, Ken. Why don't I just conclude? You said the spot price is driven by the futures price, right? That was your... So
well, it's not, it's circular, right?
Yeah,
so.
But why don't I just conclude from that speculators did their homework and they got it right? You simply had an information effect.
Oh, look, I'm not making any statements about speculative activity. I mean, to be honest with you, I studied natural gas markets long enough to know that speculation is a necessary force, right? You need to have that in order for the markets to ultimately balance. It's about liquidity. But what you can't deny through this, and by the way, it's circular. It's not just that the futures price is influencing spot. It's also that spot's influencing future. That's the nature of the simultaneity in the system. So, but what you can't deny here is that there is evidence that there were certain periods in time where those pressures were more or greater than they were in other periods of time. And you're right about doing their homework, because in fact, the only periods of time where that happened, there were other things also going on that indicated scarcity was emerging in the marketplace, right? So there was something physically happening as well. So it's not an either-or story is the point, right? That's really the key punchline here. There's a role for everything. I know that's hard sometimes for people to accept, but generally it's a more complicated story. But
follow up here, because I made the argument that, and I think natural gas markets have been a good example of this, that if I'm a speculator and I want to buy a futures contract, I've got to find somebody that wants to sell a futures contract.
Oh, absolutely. Right? Yeah.
That's the thing that a lot of people miss in this. So if I'm a buyer, I may in fact be lowering the marginal cost of production for the producer who is actually out hedging. And I think we actually saw
in gas. That's true. In gas, that's more true than in oil, because in a lot of cases, oil, it's more about physically hedging assets in an asset portfolio around the world than being really active and engaging in hedging current production.
Yeah, I think the thing I'm saying is I don't think you can conclude that the spot price ended up being higher because there was speculative activity in the futures market.
I would disagree, actually. As a matter of fact, what comes out of this is that the spot price the scarcity premiums that were emerging as a result of low inventories and low OPEC spare capacity relative to demand in particular were exacerbated by speculative activity. It's the notion that in terms of trading, that speculative pressure can be very short run, but the response in the marketplace is generally longer lived. And so you can end up with increased volatility, which you actually did see in 2008, for example. You don't seem convinced, but that's okay.
Well, I'm not convinced because at the end of the day, it's how the physical market clears. Again, speculators end up with a net trading position of 0.
Yeah.
They go into physical delivery with a position of 0. So how can a net trading position of 0 be?
No. That's you're ignoring in that statement. You're ignoring that what you saw in those periods. I think Daniel showed a picture of this actually. The people who were taking physical positions were actually on the other side of that ledger. So their position was predominantly net short, and then the financial institutions were predominantly net long, right? So if you're a producer, why wouldn't you sell into something that's going up? Absolutely you would. But whether or not you invest in that market is entirely dependent on what you think is going to happen in the physical marketplace, not the financial marketplace. And those two sets of expectations can be different.
And also, as you know, there's a tendency in independence companies. Right? And you talk, I don't know if there's anybody here from some of those companies, but I've talked about in your management, if you choose to hedge and the price keeps going up, that's called you lose your job. But if you fail to hedge and the price goes down, that's who could have called that. And so there's a disinclination to use the futures market if you're an Apache or Anadarko, a company like that. When you should properly sell your production forward, people don't, right? And that causes a skew in the participation in the market.
So who are the speculators buying from?
Other speculators who are on the other side of the market.
That's a large component of it, but there's also the component that they're actually buying from. There are physical players in the marketplace. So
the whole industry. I've had people tell me from the majors that in 2007, 2008, and 2009, they literally stopped using the futures market because it was such a poor tool for hedging, because it was so far away from their business that they stopped using it altogether. Right, and the other thing that Ken didn't mention, because he's doing this long-term study, is this nonsense that there was no inventory build in 2008, and therefore the market was purely driven on fundamentals is completely incorrect, because there was this giant build of oil at sea, the numbers of which are tracked by PIW, and you can see them on a chart. Right, so there was an inventory build, just not at Cushing.
Well, OECD at large, you can see the inventory build here, right? Particularly through the 2000s. But
you added the OECD number to that.
Oh yeah.
Well, I don't disagree with the conclusion that if you hold physical inventory and you build them into a bigger position, that will affect spot price. I have absolutely no disagreement with that. But that's different from trading futures.
Oh no, but my point is, again,
trade them against each other.
Yeah.
Right, but
again, it's about short-term pressures versus longer-term pressures, right?
So according to your theory about price movements and somebody being on the other side, it means that the price of oil would never move, because there'd always be somebody on the equal and opposite side of the transaction.
No.
Because if to get a buyer you need a seller, then there would never be more buyers than sellers, and so therefore the price would never go up and down. So that's clearly incorrect.
That's not what I'm saying.
No. I mean, you could still have movement because of marginal cost of supply, but yeah. I mean, no. Again, that's one of the key points here that I was trying to highlight, was there's a difference between short-term pressures and long-term pressures, right? And when you're responding on the supply side in terms of bringing new supplies to market, that's a response to longer-term pressures, right? The short-term pressures that's where you get the speculative, and again, I'm not saying anything bad about speculation. This is just an observation based on data analysis, right? There's evidence that there was speculative pressures exerted in the marketplace in these particular windows, okay? But the interesting thing about that, and this is where you get into thinking about policy design, right, is that only happened when the physical market got very tight. Okay? So. I think you had a question.
I was just going to comment. You said about the futures. I mean, I trade for myself, and I trade crude, and you know, I'm a very small guy, but all you gotta do is click a mouse. I mean, you click the mouse and you buy or sell, futures. I mean, it's no problem. Options, futures, and you can see guys come in and they can ramp the price 50 cents, $1, just like that. And it's not a question of who's selling it or who's buying it, but they can come in, they're spreading it against E-minis, they're spreading it against the dollar, they're spreading it against all sorts of stuff. So when you see that short-term manipulation of what's going on, it could be, Citadel, it could be Goldman, it could be whoever, it could be some big independent guy who's just jamming the price where they want it and, trying to blow somebody out on the other side. So for somebody to be able to sit there and click the mouse and do it, it doesn't matter who's on the other side. I mean, that matrix that's trading up and down is liquid as you want it to be.
No, and not only that, which
Right.
is coming out in the media now in London, some people know they're about to price something large in a contract, so they go into an illiquid market and sell just to get the price down because they're going to be buying something. Or the opposite, they know that they're going to be offering something in the market, so they buy something smaller with that when the market's illiquid to get the price up. And now people are going to go to jail out of London because there's proof that people did that. So the idea that the market can't be manipulated is completely incorrect.
This works in both directions too, by the way. I mean, there were stories a couple of years ago about a major executing a short squeeze to chase out some hedge funds and gas, right? So it works both ways.
And by the way, I'm not saying you can't manipulate forward markets. I think you can. The question is, can you manipulate a physical spot market by manipulating the forward market? That's the question.
Let's go get John Deutsch and some other people who used to trade around.
Well, all I can say is about is that the analysis that's been done here indicates that there's evidence that some of that was going on. Okay, it can't be outrightly dismissed is the point. So, yeah.
So now, since we've got futurizations of swaps, it just started Monday, and actually Dodd-Frank started 2010. We really haven't seen much volatility in the markets. Do you think that that's going to change your price forecasting or transparency of the market, kind of slimming down that volatility curve?
Well, this goes back to a question I asked Daniel actually about liquidity being injected into the market at large. That money's got to go somewhere. I think that's contributed to sort of putting a soft floor on what can happen, and that's why you've seen lower volatility,
So
right?
Yeah,
but that's again where you get into, and I think Mahmoud might actually say something about this today too. So I'm not gonna try to steal his thunder, but you get into a situation is what happens when that liquidity starts being extracted. Does it increase volatility because you're trading down? Could be. I don't know. I don't know the answer to that. All right, I think I've gone over a little bit. We've cut into lunch, so I want to sort of end it there, and let's go break for lunch.